Hey, welcome to Make Your Money Matter. I'm your host, Brad Barrett. I'm also a managing director and partner here at One Capital Management. Today on the show, I want to talk to you about how a firm like ours, who manages nearly $5 billion for private families, looks and values a company that we might be investing in. Then I'm also going to talk about how we look at the debt within that company. You might actually be shocked. But before we get into that, make sure to subscribe to the Make Your Money Matter show and hit that notification bell so you don't miss a single episode. All right, let's get into it. When One Capital Management, our firm, considers buying a company's stock or debt, we first consider the appropriate debt level for that industry or sector. Then we look at what is the company's cash generation versus interest expenses. So a good measure of this, by the way, at least for us, is something called EBIT, earnings before interest, taxes, basically. And essentially the earning before interest and taxes are deducted out of their earnings. So the company that we might be looking at has to be generating enough actual cash to cover servicing their debt. Ideally for us, 7 or 8 times more than is needed to simply cover interest expenses. This is kind of a rule of thumb that we have. Now this allows for companies to weather a slowdown, whether it's slowdown in sales and earnings, or when the unexpected hits. By the way, there's been no shortage of that lately, right? I mean, pandemic, natural disasters, wars abroad, and of course, we also want to consider when the company's debt must be repaid and their ability to borrow even more money if they need, right? So we also look at the company's future projects and earnings expended from the growth and the expansion. If the company, right, can generate more cash than it costs to issue the debt, interest on borrowing essentially, they will net more money than they had if they had not taken on the debt. Make sense? Short-lived, by the way, I should say, is the career of a CEO out there for a public company, let's say of a fast-growing company, who announces to the board, no returns this year, but we paid off our debt. Remember, there's an old adage, an old business adage to remember here. If you're not growing, you're shrinking. Fun fact, by the way, we here at One Capital, we're actually not interested in a company that doesn't have debt. That actually might be controversial to many. Without debt, the way we look at it when we're valuing a company, another company or corporate, raider out there can buy the company, then issue debt from that company to help pay for the purchase. This, my friends, is called leverage buyouts. You've heard the LBOs. This was basically how LBOs were based to buy a company. They issue a bunch of debt, usually an unsustainable amount, and then take the cash out to line pockets. Now, sadly, as I say, often every ism has a downside. Capitalism has downsides where greed can come into factor here. But what we're doing is borrowing at low interest rates and earning at higher interest rates, therefore growing and expanding the company. Even our governments need to be looking at that, right? And that's, by the way, we're going to have this debt ceiling conversation. They'll be looking at the same things. And I employ this in our practice as financial advisors with our clients. It's not necessarily to avoid all debt, but understand again in context how that debt works for you. Again, remember, as long as growth is greater than cost, having debt can be a sound financial decision. And again, us as professional portfolio managers, we're actually not interested in a company that doesn't have debt. We obviously look at what is the company's cash generation metrics, as I mentioned, but it's important to put all this in context. And I wanted to share that to you on the show today, on the Make Your Money Matter show. And I hope you enjoyed it. If you did, make sure to subscribe to our show so you don't miss a single episode. And always remember to make your money matter.